Oh, hello, it's Sue from Esoteric Trading Solutions. Today we're going to talk about superannuation, just essential knowledge that people need to know. Super is a very important asset, and often it's the second largest asset that people actually hold apart from their house, and it is a very long-term asset. So essentially, if you start working from the age of 18, this could potentially go until you're at least 69, and obviously the legislation could also change. It could even be a longer term asset than that. It could be, to 72 or something like that, with the government changing just the dates that people can access their superannuation. So generally super will apply to an Australian resident who's a salaried employee, I should say, someone between the age of obviously 18 through to 69 currently, but that could change, as I said, and they're generally making over $450 before tax. Your employer has to pay, currently at the moment, 9.5% of your base salary to a complying super fund, which is set down by ASIC, which is the Australian Security Investment Committee. They set down the rules for complying super funds, and this is called a super guaranteed contribution, SGC. So this 9.5% may also be changed. The government has flagged that they'd like to see that changed to 12.5% of people's base salary. Now, base salary is just as it is. It's a base salary. It doesn't include overtime worked or worked weekend work, where you get in certain jobs 17.5% leave loading, for example, if you're a motor mechanic and the like. So the base salary is just a base salary, and you'll get 9.5% off that base salary, not any other overtime, for example. So if you have a base salary of $50,000 that's multiplied by 9.5%, your employer, according to the legislation, has to pay $4,750 per annum. And if you say get paid monthly, for example, they have to pay nearly $397, which is the super guaranteed contribution. The employer will send this to a nominated super fund, which has to be ASIC approved. And generally, when you're an employee and you do start work with an employer, they will tend to have a super fund that's already been set up, because other employees would have been working there before you generally. That super fund, you need to find out what the super fund is, what the prospectus is, what fees are being charged, who are the fund managers and that sort of thing. So it is good to check the prospectus of the super fund, but also to check with your employer whether you have a choice to go to this nominated super fund or a choice to go to another super fund. It is really important to check, as I said, the prospectus of the super fund to find out what the costs is, the fees, what sort of returns they've made over the last 3 to 5 years, but also what sort of fees they actually take out of those returns of yours, because as an investor you get the net return, not the gross return, and that's really important. And over the longer term, as you can see, a super fund investment could last from 18 to 69 years or 70 years. That's a long time. So if you're paying a lot of fees, that certainly adds up in terms of a long, over a period of say 50 years or something. So the super guaranteed contribution that gets paid by your employer will go to a fund manager who will invest that cash, that money, into the financial markets. Now, generally when someone does sign all the application forms for super, the standard superannuation option tends to be a balanced fund option, the investment option being the balanced fund option. Now, what do we mean? What does it mean when an employee ticks the balanced fund option? Now, generally in theory, a balanced fund option, a balanced fund investment option, is a 50% option in investing in growth assets and a 50% option investing in income assets. Now, what we mean by growth assets are, for example, equities, domestic equities as well as international equities, property, which could be domestic property and international property, and alternative growth assets, which could be, hedge funds and just very alternative structured type assets, which are quite, which can be quite complicated. The other 50%, and this is a theoretical balanced investment fund, is invested in fixed income assets, domestic and international bonds, cash and credit type assets. Now, practically, when you look at how the fund manager invests your money in a balanced investment option, practically the reality is they may have a more skewed or a more weighted investment in growth assets, say 66%, and they may have only 34% in income assets. So it really depends a lot on the fund manager's view in terms of financial markets, whether they believe the equity market can continue to go up or whether they believe the equity market can go down. Their own personal view. Now, different fund managers and different funds can have a different skew of their balanced investment option, and it's really important that you, as the owner of that money, know their investment options and know how your fund is actually, how it is invested, because the reality is, if it's invested, say, 66% in growth assets, which means most of the time international equities and domestic equities, and say, for example, the All Ords, the ASX 200 has gone up for up to 50% in a year, which is a lot, because generally over history the All Ords has been showing a return of about 15% in a year. Then seriously, if you've got a fairly high allocation to equity investments, then the risk is that the equity market could come down and the returns that you've actually made over that time could get eroded. So it's really important to know how you're positioned in terms of that money with your fund manager. So it's good to at least know the prospectus and have a look at the prospectus and find out how the fund manager is managing your money. Now, in terms of, we also get another question just in terms of super. How do you interpretate or how do you understand a super statement? And since the 1st of 7th, 2005, the federal government has introduced that every complying super fund that complies with the ASIC, terms and regulations that are set down by the Australian Security Investment Committee, must offer death and disability insurance. The federal government believed at the time in 2005 that people living in Australia were very much underinsured, and they believed that people really needed more insurance when it came to disability insurance and death insurance. They didn't want to actually have to pay out disability pensions, for example. And so they believed they made it mandatory that superannuation funds need to offer these two products, death insurance and disability insurance. Now, the reality is, if anyone offers a death insurance or a disability insurance, they need to show the person a prospectus for both those, the death insurance and the disability insurance prospectus, so that you understand. A prospectus is basically all the details of what premium you're paying for this insurance. So exactly, it outlines what is covered by that insurance and all the costs, and just details exactly what the product is and the risks and that sort of thing, and the administration costs and the like. So the reality is, when these products are offered, the employee doesn't have to accept this insurance. They can make a choice, and a lot of people don't seem to know that they can make a choice. They don't actually have to accept paying a death premium or paying a disability premium for insurance for death or disability. So looking at this particular statement, we've got STD, death only premium, STD, TPD only premium, contributions tax, administration fee, asset-based fee, contribution tax, and the like. And we'll go through each of those terms and just define them. So a standard death only premium is essentially death cover. So you pay a premium for an agreed sum through the fund, which will be paid either to your family, or someone that you nominate to receive that money upon your death. So people generally generally pay premium for death insurance when they have debts, or they've got a mortgage, or they've got some sort of debt they don't want to leave to their family or their spouse or the agreed nominated person. That's when they generally do have death only premium. But it's not to say that you may not have debts either. They may decide that they want a death insurance anyway, so that they know that their family will be safe if they do die prematurely. In terms of standard TPD only premium, that's basically standard total and permanent disablement insurance. And again, you pay premium for insurance that covers you with a lump sum if suddenly you become terminally ill or suffer a long-term disability. That prevents you from working. Now, this is where the prospectus is really important as well, because obviously with death you're dead, but with permanent disability, what does the prospectus cover? What sort of disability are we talking about here? Are we talking about, someone with a loss of sight, a loss of hearing, a loss of arms, a loss of legs? When does this insurance kick in, this lump sum, for what sort of disability? So this is where the prospectus is really important to find out how they define permanent disability or disablement as such, and what is it total, or what do they regard as total and permanent disability? And that may change. That may be different according to different insurers as well. So it's really important to check that out in terms of the prospectus. Administration fee, again, this will be a prospectus within the super fund itself, and administration fees again are really important too, because they can change quite dramatically depending on which fund you're talking about. I've seen administration fees anything from 0.5% to 4.5% per annum. Now, it really makes a big difference on a superannuation balance, because, as I said at the start, super is often people's second largest asset. And also, it's a very, very long-term asset. So you can appreciate if you're employed when you're 18 and you're still working up to 69. That's a very, very long-term asset, and fees can really erode the returns of your fund over time. And particularly if it's a monthly fee, you've got that accumulation effect as well. Every month you're being charged a fee of a certain percentage, which is eroding the returns of your fund as well. So it's really important to check out those fees and to find out how much they are. Another thing you might see in your statement is an account-based fee, which is basically a fee that the fund manager will charge for the managing of the assets of the super fund. So again, these fees can also add up as well. It depends on, it's basically the cost of dealing with the fund manager in the financial markets. Again, if they're dealing in a liquid type assets, those account-based fees can be quite high. If, for example, they're turning over the fund a lot, for example, they're going into equities, getting out of equities, turning them over again, getting out of them, then, those fees can add up to quite a bit as well. So if you've got a fund manager that turns stuff over a lot, then your administration, your account fees can be quite high as well. So again, the prospectus of the super fund should show that, and you should make a comparison with other funds. Contributions tax credit. Super fund is generally taxed at 15 cents on the dollar, rather than, say, an individual tax rate of 30 cents on the dollar, and with Medicare levies. So super is a form of saving, but it's a form of long-term saving, because the fund is only taxed at 15 cents on the dollar. And plus you've got contributions, which are the super guaranteed contributions, which currently, as we've said before, are 9.5% of your base salary, and they don't include leave loading or overtime worked on the weekend and that sort of thing. Well, I hope that sort of clears up a little bit about super. I hope that helps. Look, thanks very much for listening, and if you do have any further questions, please send us an email, or give us a tingle, or get onto our chat line and send us an email from there. Thanks very much, and look, thank you very much for listening, and much appreciated. Bye for now.